You can almost hear the trapdoor creak open in this one. It starts with borrowing roughly $123,000 in total loan principal against a life insurance policy, then snowballs into about $205,000 of loan payoff once the interest stacks up, and it all happens over the stretch from May 9, 2009 to July 26, 2015. With the interest alone rising by around $83,000 until the tax court lands on a taxable amount of roughly $161,000, even though the taxpayer insists he got no cash at all. This one is one of those stories where the word Constructive does a lot of work, and the theme ends up being painfully simple. A policy can die on paper and still leave you holding a tax bill. My name is Dvorkin. I'm a certified public accountant in the state of California, and on this channel I review and analyze U.S. tax court cases to understand how U.S. tax law works. And if this is your thing, please like this video and subscribe to this channel, because these cases are where the rules stop being abstract and start being personal. In this video we cover the tax court decision in case of Jonathan Sawyer versus Commissioner of Internal Revenue, decided on April 16, 2026. The opinion opens by introducing the taxpayer as someone who didn't just own a business, he was the business. The court describes a family printing operation that dated back to 1800s and says he owned and operated it for decades, ultimately becoming the chief executive officer and owning all of its common stock. He is not presented as passive investor watching numbers move on the screen. He is presented as someone in the building doing the work, trying to keep the doors open. Back in 1982, he took out a life insurance policy on himself from Northwestern Mutual, originally with his wife as beneficiary. The policy mattered to him for the most basic reason. If something happened to him, he wanted his spouse provided for. The policy also contained a feature that ends up driving the entire case, an automatic premium loan option. In plain terms, if he didn't have the cash to pay the premium, the company could effectively front it by borrowing against the policy's own value, keeping coverage in force, but quietly building up loan balances plus interest. The court notes that, like all loans, those premium loans accrued interest. And it also notes the policy had an internal safety valve. If the loan balances ever met or exceeded the policy's cash surrender value, the policy would be automatically canceled. Then the business story darkens. The court explains that printing got volatile and capital intensive. Staying competitive required equipment, serious equipment, with serious price tag. One example in the record is a printing press bought in the late 1990s for around $1.5 million. And the court describes the taxpayer having to personally guarantee that debt. Later, when the balance was still in the range of $1,200,000, he had to refinance, and he was required to pledge his personal residence as collateral. So the business pressure wasn't theoretical. It reached into his personal life and grabbed the biggest asset most people ever have. And then, as the opinion tells it, the major customer account disappeared in mid-2000s. An account worth roughly $1.5 million and representing about a third of total sales. The court plainly paints the picture of a company wobbling and a taxpayer repeatedly stepping in to keep it upright. He injects cash for wages and payroll taxes. He buys supplies. He tries to keep equipment running. To do that, the court says he liquidated a retirement account worth approximately $150,000, ran up roughly $100,000 on credit cards, and borrowed about $750,000 from his uncle. And when the business defaulted on a bank loan, foreclosure proceedings hit his personal residence, forcing a sale to satisfy the debt. This is where the life insurance policy stopped being a background detail and becomes a lifeline, at least for a moment. The court says that on May 9, 2009, he borrowed about $80,000 from Northwestern, secured by the policy's cash surrender value. Northwestern sent the check to the business address and it was deposited into the bank account. But right alongside that, the taxpayer says he believed he directed the business bookkeeper to send paperwork transferring policy ownership to the business. That claim matters because if the business owned the policy, then maybe the later consequences shouldn't land on him personally. The problem is that the court didn't find evidence the transfer actually happened. The policy itself allowed ownership to be transferred, but only effective once Northwestern received satisfactory written proof. The bookkeeper didn't remember filing it, and Northwestern's record didn't show a change in ownership. The business ultimately didn't make it. The court says it was liquidated in 2010, selling equipment at major losses, like that press that was bought for about $1.5 million being sold for roughly $150,000. Records were lost or destroyed during the closure process. After that, the taxpayer found work at another publisher, but the opinion adds a lingering consequence. He remained liable for payroll tax liabilities tied to the business, and a significant portion of his wages were garnished until that was satisfied. Now the plot twists. Even after the business shut down, Northwestern kept sending correspondence about the policy addressed to him, showing him as the owner. He believed it was an error. He tried once in 2013 to contact the agent and learned the agent no longer worked there. And then nothing. The court says he took no further action to clarify ownership with Northwestern. Then came the cancellation notice, July 26, 2015. By that time, the policy loan and the premium loan balances plus interest had eclipsed the policy's cash surrender value, leaving the net value of zero and insufficient liquidity to cover future premiums. Under the policy term, Northwestern automatically terminated it, and when that happened, Northwestern treated the policy's cash surrender value, about $205,000, as applied to satisfy outstanding indebtedness. One bucket was the original policy loan principal, around $80,000, plus interest on the order of $40,000. And the other bucket was premium loans with principal in the ballpark of $43,000 plus interest of roughly another $43,000. The grand total satisfied was about $205,000. The taxpayer's investment in the contract, the basis, essentially was stated as about $45,000, making the taxable portion of the distribution roughly $161,000. Northwestern issued a Form 1099-R reporting that taxable amount. And here's where the human part of the story takes over. The taxpayer did not file a tax return for 2015. The court explains that he believed the Form 1099-R was inaccurate, so he consulted with a number of tax attorneys about how to report it, but he did not receive a clear answer and ultimately did not file. In response, the IRS prepared a substitute for return. The IRS notice of deficiency determined a deficiency of roughly $50,000 along with additions to tax for failure to timely file and failure to timely pay. There was also an estimated tax addition initially, but the opinion says that the piece was conceded away. The remaining fight focused on whether he constructively received that roughly $161,000 when the policy terminated, whether he could deduct investment interest tied to the policy loan interest, and whether he was liable for the filing and payment penalties. The taxpayer's main defense on the income issue was ownership. He argued that in 2015 the now defunct business owned the policy and therefore was the party entitled to the cash surrender value and responsible for the loans. But the court walks through the evidence and concludes the policy stayed his the whole time. It emphasizes that while he may have intended to assign it, his actions do not support an actual transfer. And it notes something else that cuts against him. There wasn't any apparent mechanism for the business itself to borrow from Northwestern. He, as insured and policy owner, had to borrow and then inject the funds into the business as capital contribution. Once the court settles ownership, the tax results become much harder to avoid. because the next move is a legal framing move. Gross income includes all income from whatever source is derived, and the court treats gain inside a life insurance contract as taxable when non-annuity amounts received exceed the investment in the contract. The taxpayer's emotional argument is easy to understand. He didn't receive anything. The policy value just got vacuumed up to repay debt. But the court answers that with precedent relying on an earlier case where policy termination triggered Form 1099-R and the cash values were applied to repay loans. The tax court's logic is that treating loan satisfaction as non-taxable would allow untaxed investments return to escape tax altogether. And it says there is no basis in the law for that. In other words, the law treats the loan payoff as if cash was first paid out to the taxpayer and then used to repay the loans, even if in reality no checks ever hit his hands. So, on the main issue, the court holds he constructively received taxable income of about $161,000 when Northwestern terminated the policy in 2015. But the case doesn't end there. Because the court doesn't give him something meaningful, it addresses whether the interest on the original policy loan, about $40,000 of interest tied to roughly $80,000 loan, could be deductible and investment interest. The taxpayer argued that under tracing rules, the borrowing should be traced to the use of proceeds, and he said the proceeds were invested into his business by way of stock investment. Basically, he borrowed personally and then put the cash into the company to keep it alive. The IRS argued he didn't substantiate where the funds went. On this point, the court makes an important credibility call. It describes him as quite a credible witness and finds he established that the loan proceeds were invested in the business. It acknowledges missing records, but it also notes the company's records were destroyed when closed. It even notes the bookkeeper's hazy testimony, vaguely recalling the transaction but uncertain whether he recorded it. On balance, the court accepts the taxpayer's version that the loan proceeds went into the business. Then the court moves to the legal category. Was the borrowing connected to property held for investment? The reasons that stock is generally productive of dividends and fits within the statutory definition. And it concludes the business stock here was property held for investment, making the interest investment interest. But that comes with a limit. Investment interest is only deductible up to net investment income for the year. So he doesn't get a blank check deduction. He gets a deduction only to the extent of his net investment income for 2015. He tried a second interest argument too, about the premium loan interest, suggesting the life insurance contract has insurance and investment characteristics. But the court rejects that, noting no evidence was presented on how to allocate interest between those aspects and leaning on legislative history that treats interest on borrowing to purchase a life insurance policy as personal interest. The court says that kind of premium loan interest is personal interest and not deductible. And it also flags an additional statutory barrier that would prohibit deductions in certain premium financing scenarios anyway. Finally, penalties. The court evaluates additions to tax for failure to timely file and failure to timely pay. For filing, the taxpayer's defense was basically confusion. He sought advice, didn't get clarity, and didn't file. The court's response is blunt in practical terms. Even if the policy reporting was confusing, he still had wage and other income requiring a return. He wasn't told not to file, and he couldn't rely on advice not to file even if he had gotten it. So the failure to file addition sticks. But for failure to pay, the court goes the other direction. It looks at his financial reality in 2015, wages around $36,000 with withholdings of roughly $6,000 and a deficiency determined around $50,000, more than one time his wage. It observes his prior wage garnishments for payroll tax liabilities, the sale of his home years earlier, and the exhaustion of personal assets trying to keep the business alive. It concludes he didn't have assets or income to pay. His inability to pay wasn't due to negligence or lavish spending. And this is a key story bit. The cancellation and the magnitude of constructive income were not reasonably foreseeable. So the court finds reasonable cause for failure to pay, and that addition is not satisfied. The ending then is mixed, like so many tax court endings are. The court holds he had taxable constructive income of roughly $161,000 from the policy termination, allows investment interest on the policy loan interest, but only up to the net investment income limits, sustains the failure to file penalty, and removes the failure to pay penalty. And the deduction is entered under Rule 155, meaning the math gets finalized after the opinion based on the court's holding. The lesson of this story is that the tax law can treat money as having visited your wallet, shook hands with you, and left without ever actually showing up. And if you don't file because you start arguing with a piece of paper, the government will still insist on meeting you where the paper says you live. My name is Dvorkin. I'm a certified public accountant in the state of California. If you found this information useful, please like this video and subscribe to this channel. And I'll see you in the next tax court case review.